You are 23. Your balance is $847. You walk into the branch on a Tuesday because the website wouldn't let you finish. A woman hands you a pen. You sign 3 pages. You leave with a debit card in a paper sleeve and a savings account earning 0.01% APY. 90 days later, you have paid $68 in overdraft fees. The first charge was $32.14. The fee was $35. You looked at the transaction twice. You did not call. You bought gas. The pending authorization held $1 more than the pump charged. The account dipped to 83 cents before the correction posted. That gap, 90 seconds wide, 83 cents above zero, cost you $35. You didn't read the agreement wrong. You didn't misunderstand the product. The product worked exactly as designed. Gerald is sitting across from you at lunch when you mention it. He holds his phone with both hands and laughs. Not unkind, just fast. Just get a prepaid card, he says. Not advice. He turns his phone over. The bank collects $33.58 billion in overdraft and non-sufficient funds fees annually. Most of it comes from accounts that look like yours. The shift. You stop thinking the fee was a mistake. You start thinking it was the margin. You keep the account. The monthly minimum waiver requires a balance you don't have. The $12 fee posts. You have one institution, one card, and $847 that becomes $835 when the next cycle closes. Same institution, different rules. The bank's most profitable customer is not the one with the most money. It is the one who cannot afford to leave. Below $10,000, the bank considers you a maintained liability, not a cultivated relationship. Your balance clears $1,000 on a Thursday in March. The overdraft fee doesn't post that month. Nothing else changes. The savings account still earns 0.01% APY. On $1,000, that is 10 cents over 12 months. You do not celebrate 10 cents. You leave it. No letter arrives, no call. The app looks the same. The branch is the same building with the same hours and the same woman who hands out pens. You wait, without naming what you're waiting for. Nothing comes. The arithmetic running underneath everything continues. You are no longer being charged to stay. That is the difference. Brianna mentions it at dinner, not to you specifically, the way people say things that are meant for everyone and no one. She got invited to a different kind of account at her bank. She doesn't explain what kind. She touches her phone screen twice and puts it face down. She keeps eating. You don't ask. Your balance reaches $4,247. At 0.01% APY, the interest for the year is 42 cents. The bank has held your money for 12 months, deployed it at rates you don't have access to, and returned you 42 cents. Something isn't anger. It is the low, constant awareness that the structure is not neutral. Same institution, different rules. The bank has stopped taking from you. It has not started working for you. Those are not the same thing. The envelope arrives on a Tuesday. It is heavier than the standard ones. That is the first thing you notice. Inside, a letter on cardstock. Your name is printed at the top, correctly. You have been selected for preferred banking. A name is printed below, your relationship manager. He will call once a quarter. The first call lasts 4 minutes and 12 seconds. He asks if you have any questions. You say no. He says he is available if anything changes. You write his name on a post-it. You lose the post-it. The fees are waived. The savings APY moves from 0.01% to 0.05%. On your current balance of $14,800, that is $7.40 per year. You do not celebrate $7.40. There is a promotional offer, a 12-month CD at 4.85%. You write the math in the margin of the letter. $14,800 at 4.85% for 12 months. $717.80. You fold the letter. You don't act yet. Marcus works in accounting. He is not a banker. He looks at the letter the way someone examines a utility bill. He says the bank's net interest margin on a preferred customer runs $1,400 per year. Not profit from products, from the spread. What they borrow your money at versus what they lend it at. He says it the way someone explains weather. You look at $7.40. You look at $1,400. The shift. You stop measuring service by what you receive. You start measuring it by what they still won't offer. Same institution, different rules. Preferred status is not recognition, it is retention. The bank's attention is not personal, it is actuarial. You have crossed the threshold where losing you costs more than serving you. A human being calls, not a menu, not a callback number. A human being who uses your name correctly on the first attempt. You are offered things you have not heard of in this building before. A structured CD, a preferred mortgage rate, wire transfers with the $25 fee waived. He schedules a review. He sends a calendar invite with your name in the subject line. His name is Raymond. He takes notes on paper, not a screen. He references a conversation from your last visit, a visit you did not have with him. He pauses one beat too long before every answer, the way someone checking a file pauses, except there is no file visible. You don't mention it. You find the online HYSA on a Tuesday night, 5.2% APY. You do the math on $94,000. That is $4,888 per year, against the bank's current offer of 0.05% on savings, $47 annually. The difference is $4,841. You open the transfer screen. You fill in the routing number. You get to the confirmation page. Raymond calls the next morning, 6 hours and 14 minutes after the timestamp on the transfer screen you did not submit. He doesn't pitch. He asks one question. What would make this simpler for you? You close the tab. You are not certain why. Something moved. You don't know what it is yet. Same institution, different rules. You drive past the branch on a Wednesday. You are on the way somewhere else. The ATM vestibule is the same glass. The hours are posted in the same font. A woman inside is handing someone a pen. You don't stop. Clients at your current tier do not use this building. The relationship happens in a quieter office. No teller windows, no rope queue, no coin machine humming near the entrance. What you have access to now: trust services, family office structures, tax-optimized portfolio construction using asset location strategies across taxable, tax-deferred, and tax-exempt accounts. Alternative investments unavailable to retail customers. Private credit, real assets, funds with no posted rate and no public prospectus. The bank is no longer waiting for you to leave. It is arranging things so leaving costs more than staying. You think about 42 cents. You think about $33.58 billion. You think about the 90 seconds when the authorization hold on $1 dipped your balance to 83 cents, and the fee posted before the correction arrived. The building has not changed. The branch manager is probably the same. The pen the woman is handing out is probably the same brand. You look at the ATM vestibule for 9 seconds. Then you pull out of the lot. Same institution, different rules. At the top tier, the product is no longer the account. The product is access, and access has no posted rate. The next video is Your Life If You Never Invest in Your 20s. The math is brutal. You understand what the bank does with the margin. The next question is what you do with yours. Subscribe. You're already in it.